On today's Hashi, I'm discussing housing inventory for the past 7, Zillow's downgraded forecast, and Americans canceling major purchases. Today is Monday, April 21, 2025. I am Byron Lazine, and the Hashi starts now. Good morning. Welcome in live from Naples, Florida. Glad to be here. Glad to see all of you. Let me know in the live chat which market you are tuning in from here today, wherever you may be. I am thrilled to be back after a week off. I was like jealous this last week, knowing that all of you were on the Hashi and I was not. I was very jealous of, having to turn over the reins to Jeremy Knight and Tom Toole. I'm sure those guys, I know those guys carried the torch, and I appreciate their support while I was away. But there's like nothing worse than a vacation, right? It's like it almost seems like work. It's one of those things that throws you out of routine. I'm just glad to be back. So let's get right into it. Let's kick it off as we do on Mondays with an inventory update for the last 7. How is inventory trending? What's it going to do ultimately to this market? Is it going to lead to any price pressure? We have a Zillow report here that suggests that it just may. Really, actually shocking report that was released over the past week while I was away. I'm looking forward to digging into that. Let's start here with our inventory here over the last week. According to Altos Research, weekly inventory rose from 702,000 plus to 719 plus on single family active listings across the country. This is a big number. This is a big jump. Considering the fluctuations in rates over the last, week, 2 weeks, really 2 weeks on rates. Same week last year on inventory, we're at 542,000. So we're about to cross over the peak for all of last year. If we get another 20,000, we almost got 20,000 new active, or not new, but we almost got a 20,000 bump on active inventory over this last week. We get that in the next 7. We get that. Certainly we'll get it in the next 14 days at this trajectory. We'll be over the peak of last year at 739,000, which we didn't hit until October. Okay. Last year's peak inventory on the market was October, 739,434 across the country. We'll be there. We'll be there in May. It might be the last week of April. It just could be, but we're going to be there for sure in May. Love the month of May, Kentucky Derby month. By the Kentucky Derby, we're going to be at the peak of active inventory that we saw last year. So what's it going to look like in October? What's active inventory going to look like this fall? It's going to be considerably higher. Where everybody's looking for active inventory on single family homes of somewhere close to 1 million. That's when you're really going to see significant price pressure if demand doesn't go up, which will stabilize pricing and hopefully make things more affordable. We'll see what happens with rates. But looking for about 1 million on inventory across the country. I know there's places that are like, no, we're not looking for that because that means ours is going to go up even more. You're talking some of the soft spots, maybe in Austin, maybe a Southwest Florida, these types of things that are really soft on inventory and maybe aren't looking for an inventory boost. But there's parts of the country like, keep the inventory coming, even it out, make it a buyer's market here. And you get up to 1 million nationally. I'm not calling for 1 million this year, but at that point, you're really going to see the pressure on the prices, and it's going to make it easier for buyers. And that's where you're going to see some of the more opportunities for negotiation and making things a little bit more affordable for buyers. But certainly we're going to get to 740,000, which is the peak last year. We're going to get up over 800,000 this year. How high is it going to go? What's it going to do to prices in the second half of the year? That's going to be dependent on demand, where the 30-year fixed rate's going to go, all of that. Okay. We're going to cross over the 2020 mark. Obviously, 2020 was on the downside, at this point, or starting to get to the downside on inventory at this point of the year back in 2020. We're going to cross over probably in a week. How high can we get towards 2019 levels? This is the line that I'm looking at, 2019, because that's the last real normal market you can point towards. It was advantage sellers, but it's the last, more normal market across the country before what we saw in 2020, which 2020 was going to be an extreme sellers market regardless. Obviously, everything changed there. But how close to this 900 plus thousand level on active inventory can we get? We are going up. Will we catch it? Remains to be seen. Our peak last year was in October, so we should still have May, June, July, August. We have a lot of months to accumulate active inventory. Okay, the history would tell us that would be the case. It will be dependent on how many of these we get. That's new listings coming onto the market. Every single week we are beating last year's mark. So we're doing, this is now a 3 month plus trend on new listings, according to Altos Research. 77,000 new listings over the last week versus 68,000 the week prior last year. So we had 59,000 in 2023. So starting to get a healthier place on new listings coming onto the market. Rates haven't changed that much in the last couple of years. Okay, we're hovering around 7%. I know last week we dipped below 7%, thankfully. We had some stabilization finally on the 10-year. Rates are basically what they were, though, if we look the last, couple of years, all things considering, this is where we've been. We'll look at the last 5 years on rates, just so I can easily get to, April 2023 levels. If we're at, what are we, the 21st today? April 21st, it was a Friday in 2023. That was 6.66. Okay, we ended the week last week at 6.88, and April 21st, 2024, we'll settle in on April 19th. That's fine, 7.44. So obviously last year's April a little bit higher, but by the beginning of May, we were already down to 7%. So we had some volatility there. So a year ago, we were up over 7%. We're just under 7%. And 2 years ago, we were a little bit under where we are today. But we were all 3 years hovering in either the high sixes, up above 6.5, or the low sevens. And so we see new listings now, 2.5, 3 years, really 3 years into high interest rates or higher interest rate environment than what we got used to. And we're finally seeing sellers kind of give up. That lock-in effect is starting to, ease up. The Cold War, as I called it before, national media gave it the title of the lock-in effect. The Cold War is thawing out. Okay, 59,000 2 years ago on new listings, 68,000 for the same week a year ago, 77,000 now. Week over week over week, we're seeing improvement. Are we going to get to that 80,000 to 100,000 level that Logan over at HW is looking for? Remains to be seen, but we're close. We're 3,000 away. We might get there. Okay. More homes that are coming on the market and more inventory that's starting to accumulate. We're actually seeing this number be kind of elevated above what you would expect. We expect 33%. We're at 35.5 right now on price cut percent of properties with recent price reductions, 35.5% versus a 32 last year and a 30 the year before. So that's that price pressure that I'm talking about with the more accumulation of inventory that we're going to get. New listings keep coming on the market. We expect inventory to keep moving up. And we're seeing a little bit more price cutting. And a lot of that's driven by the Sun Belt states that have more inventory. You're not seeing that, obviously, in Northeast, certain areas in the Midwest. You're not going to see that because there's less inventory. But those areas where inventory is outpacing pre-pandemic levels, true buyer markets, you're going to see those price cuts happen a little bit more often. If this number were to normalize. This is the spread between the 30-year and the 10-year. Okay, we're back to like 2024 levels right now on the spread. If this were to normalize, get down here closer to where we were trending early in the year and get closer to maybe 2, if it were to be, I mean, the normal spread's more closer to 1.8, but if we got just even closer to 2, the 30-year fix just right now would be closer to 6%. And if we got closer to 6%, that increase of inventory would be meaningful to more buyers, more would-be buyers. You'd see transactions go up. We get rates down to 6 with the inventory levels that we see coming on right now. If that inventory level maintained, we would see a market that's really getting back to healthy in a hurry. There'd be more fluidity. Transactions would be moving up. A market would just seem more normal, seem more healthy for more people. We are seeing total home sales going into a contract pending status kind of hold firm above last year's level, just barely 391K versus 384K. But now consistently here week over week for a few weeks anyways, we're seeing more homes in contract pending status than we saw last year. Now, what we typically see here over the next 2-3 months is that we'll flatten out at this level. Okay, these are weekly pending contracts for the last week, 391,000. We'll see it kind of flatten out. 2024's peak was in June at 406,000 on pendings. And we don't see that decline when we're looking the last couple of years anyways. We don't see that decline until we kind of hit July. So, how high can we get here before we see it peak out and flatten out remains to be seen. We'd love to get into the 400s and it kind of exceed last year's peak. If we're going to exceed last year's existing home sale data, which was, relatively around 4 million, that's the bottom level. These are historic lows when you factor in, population and all of those kind of, age ready buyers, all those kind of numbers. Okay. We did see demand go down last week as expected on mortgage applications just due to where the rates were, but year over year still, and I know either Jeremy or Tom updated this last week, but year over year demand still exceeding where we were last year. So good sign that we could get there on some of that forward moving data with the pending sales and then ultimately impacting the total existing home sales. It's going to be a slow slog to get there, and some markets are feeling it more than others, but all signs to me, despite some of the issues that we're faced with, are pointing up still as we look at some of this data. It's not going to be an accelerated move into, wow, look at all these existing home sales. It's going to be incremental. It's going to be week over week. It's going to be month over month. This week's data is still looking good for me. Not looking good for me for home owners, maybe for buyers and easing up on affordability, is Zillow's recent U.S. home price forecast. Okay. So Zillow's downgrading now their U.S. home price forecast, going bare on the housing market in terms of pricing. This is their first real move in this direction. Tons of data. You can love them. You can hate them. They've got data. You got to respect them. Skylar Olson, who is chief economist, we've had her on Knowledge Brokers. Really enjoy Skylar quite a bit, chatting with her. She's got a very bubbly perspective on being an economist, and love chatting with her. She says more sellers came out to test their luck as rates tick down, right? Think 3-4 weeks ago, March, you saw sellers coming out. And so it is some of these new listings that we're seeing that I just spoke about. Is this kind of like is this going to be a trend going into the spring, to Skylar's point? Like, are we going to, is it just kind of the remnants of what we saw in March? They were planning this out. Now they're like committed. They're getting their house on the market, or is it a trend and we're going to see a healthier come to market rest of the spring, early summer market? That remains to be seen. Skylar says that sellers came out to test their luck. Home sales didn't keep up. She says buyers, especially first timers without equity to pour into their first down payment or into their down payment, continue to struggle. And affordability is now, being faced with higher levels of uncertainty. And for those reasons, including others, Zillow now is predicting that home prices are going to move down. They're forecasting a 1.7% year over year drop in home values by March 2026. So looking March to March, they're saying near 2% drop on home values. Now they had a bullish outlook, so this is a reversal. Okay. Zillow's March 2025 housing report does show a 0.2% month over month increase. Inventory up 19%. So inventory, one of the other reasons driving, a potential decrease here in these home values. But this is the first time we've seen them in recent memory not only downgrade the 12-month forecast into the negatives, but substantially into the negatives here at near 2%. So a surge in new listings, affordability barriers for the buyers. How many buyers can enter this market? One of the factors. Buyers are hesitant to act. We're going to get into this Redfin report about how hesitant buyers are to react. Hate their headline, as I typically do for Redfin, but the data is substantial, so we'll take a look at it here next. And so despite the mortgage rates where they ended up in March, Zillow believes that, hey, these numbers are going to move down. Now, 2% with the gains that we've had. Listen, like if I just jump in and BAMX members, you guys know where to find this. If I just jump into BAMX on school, right? If I go into Classroom and I jump into Hot Sheet, daily market data slides, obviously got all of the April slides here. But if I go into most popular charts and go to one of my favorite, the home price growth by decade, to like help educate buyers, like, hey, what do you think is going to happen if you wait 5 years? I mean, just look at the last 4 decades, what happens to home prices. I mean, look at this year. We're 47% this decade. You lose 2%. Not that big of a deal here for home sellers. One of my favorite slides to educate buyers, or even, somebody who's like, oh, I might sell next year, like, but I hear home prices going up. They're going down 1.7%. If it's better for your life to sell next year than this year, I might, just stay in the house for 12 months, like, what are you going to move twice? Everything is personalized and dependent on where you're at. Also here in the same Classroom, you can go over to April 21st today and get all those slides that I just went over if you're a BAMX member, including here the forecast for the metro level home price change here between March 25 and March 26. So you've got areas, think Northeast, where Zillow's still saying, hey, I think these markets are going to move up. You got Sunbelt states where New Orleans down 7.6% year over year, Austin down 4.1% year over year. Think Southwest Florida down, think San Jose down, Phoenix down. So Sunbelt, Zillow's like, hey, these are going to be down more than other areas in the country. Northeast, they still have moving up when they look at this forecast for now, March 2025, year over year to March 2026. If you want to get access to all these slides like BAMX members have access to, all you got to do is actually just join BAMX. Just go to school.com/BAMX. You can easily just download all these daily slides. We do this every day, hot sheet show notes, as well as our slides in the BAMX. Download whether on the mobile app with school or desktop right here at the top right. They both function the same. Here's another look at these 1 year change on home prices. Now in reverse here, just going back the past year. So they see more of the same. Okay. So Cape Coral is down 8% over the last year. Punta Gorda is down 9% over the last year. That's Southwest Florida really taking the hit over the last 12 months. And you've seen places like the Northeast, Hartford up 4.7, Rochester up 5.9. You go Midwest, Detroit, Milwaukee up. So predicting more of the same going forward over the next 12 months, as we just saw, but not as big of numbers, right? Hartford, instead of 4.7% up, they're projecting 0.7%. Rochester, New York, not a 5% increase, 2% increase. Okay. And so more trend of the same we saw the last 12 months is what they're projecting out, but the numbers just aren't maybe as substantial. Now, a metro can swing 7, 8, 9%, like we're seeing in some of the Sun Belts, or to the upside that we're seeing in the Northeast. They can have those big swings, but when you average this out nationally, Zillow is really just calling for a 1.7% decline. It's going to change in your local market. When people see 1.7% decline nationally as projected by Zillow now going bear, and they're in the Northeast, there's an education process of like, well, hey, that doesn't mean you in this price range, in this town, in this county. Here, let me just kind of walk you through it. And here's a look at some of the top gains. I mean, Zillow's not projecting huge swings for the top 10, gainers over the next 12 months. This is among the largest 300 US metros. This is where they see the strongest increases. These aren't huge numbers. So even in the areas where they're saying there's going to be an increase, they're not a total, they're not a total bull in really any market across the country. I mean, they got Atlantic City going up 2.4% as the number one market. If you've been to Atlantic City, you're probably thinking, what? Really? AC? But Atlantic City up 2.4%. Kingston, New York, 1.9%. Rochester, 1.8%. Knoxville, Torrington, Connecticut. That's your top five. Bangor, Maine. Syracuse, New York. Vineland, New Jersey. Concord, New Hampshire. And then Norwich, Connecticut. Bought my first house ever in Norwich, Connecticut. Total mistake that was, but Norwich, Connecticut being up 1.2% as a projection here, making the top 10. What does this top 10 tell you? It's all Northeast. It's Eastern Seaboard. That's where the markets are moving up per Zillow. And then what do you see in the top 10 here where they're saying, watch out in terms of price here over the next 12 months? It's Louisiana. Louisiana is just getting beat up here on these projections year over year. Top 6, Louisiana. It's Gulf Coast areas. It's Texas. It's Louisiana. It's Texas. It's Louisiana. Surprise, there's not some more Southwest Florida in here, but these are big numbers. It's Louisiana. It's Texas. You're really taking the brunt of the most bearish outlook when you look at these metros. I think, let me see if this is linked up. I know it's linked up. It'll be linked up. It should be linked up in my show notes. There's actually if it's not, I'll make sure that it gets linked up here. Let me look in the show notes. It'll be linked up. Let me just go to it. It'll be linked up in your Zillow show notes. There is a Google Drive the BAM team here put together on all these markets that Zillow is forecasting. Okay, so these, if you're interested in the metro for a particular market, according to Zillow, over the next 12 months, it's all here, and it's like the majority of it's in the negatives. Okay, so if you're looking out forward, you want to send out some content, you've got a lot of this. These are the top 300 that we mentioned. So you've got a lot in the negatives. You can top 300 market. You're either near one of these markets or in one of these markets. If you want to pull any of that data, it's all available. It'll be inside of BAMX show notes for you. Okay. All right. That's Zillow's forecast moving forward. We'll keep our eye on it. Some of these, listen, a lot of the forecast, they didn't predict as high up as some of these markets would go very well. And it remains to be seen if they're saying to the downside, it's something to watch. Are they going to predict how far down it might go? Maybe it doesn't move down at all. They're one of the first to come out here and say, we're going bear on home prices, and we're going bear where we're almost at 2% down. 2%, not a big deal if you're not selling your house. Not even really a big deal if you are selling your house. It's like, hey, my stocks are down. Okay, I'm not selling them. So what does it matter to me? It's not that big of a deal. And so if the homeowner isn't selling it, is it really a big deal? People like to have equity. Equity is not worth anything until you use it. Redfin says there are a lot of Americans that aren't even going to consider, though, getting into the game of equity. In fact, Redfin states that 24%, 1 out of 4 Americans, are scrapping plans to make major purchases like a home or a car. You know what? I would say with the uncertainty of the economy, I would agree with it. But of course, they say, due to tariffs, Redfin survey, due to tariffs, 1 out of 4 Americans are going to say, oh, I'm going to stop all major purchases because of tariffs. Listen, 1 out of 4 Americans couldn't even explain what a tariff is, but yet 1 out of 4 Americans are going to stop plans to make a major purchase due to tariffs. Redfin always wants to tie in. I asked ChatGPT, I said, are economists like the Redfin economists supposed to be political in every single report that they put out? ChatGPT said, no, economists are not supposed to be political at all. They're not supposed to be partisan. They're supposed to just give you data and facts. But they've got to, like, 1 out of 4 Americans are going to stop making major purchases because of tariffs, but 1 out of 4 Americans couldn't even explain or walk somebody through a tariff or the implications it's going to make. Like, just call it what it is. Like, change this to uncertainty in the economy, which has been around for, I don't know, 36 months now. Uncertainty, or just like go back to November 2024 exit polls. What did they tell us? Like, this economy is not working for most Americans, has not been working for most Americans, continues to not be working for most Americans. You print 80% of US dollar in a 4-year period. There's going to be a bill to pay at the end of it. We're still dealing with it. This economy has a lot to clean up, a lot to puke up, in fact. But nearly 1 out of 4 U.S. residents, according to Redfin, they're going to cancel plans to make major purchases, buying a home because of a car, all because of the tariff policies, according to this Redfin survey. I just literally, I think it's wrapped up more into just uncertainty in the economy, and the tariff is the latest headline that encompasses how uncertain the economy is in a variety of different factors. It's not like pre-tariff, this economy post the January 20th inauguration was a great pre-inauguration or post. Okay. So, like, the economy didn't get fixed on January 20th. It wasn't fixed before January 20th, and it's still not fixed. And I think that's just catching up with a lot of Americans, where it's like, yeah, it's harder and harder and harder for more people to make major purchases right now because the economy doesn't support everybody right now the way that it should. 55% of respondents are less likely to make major purchases this year, including 39% who are now much less likely. 56% of Americans are canceling or delaying due to the two major tariffs. So overall, 8% of them already made a major purchase sooner than expected. Redfin, actually, I think this is good, breaking it down to political. They just want to play politics so much. Like, Redfin wants to be, they want to be on the next Gavin Newsom pod or Charlie Kirk pod. Like, they want to be the next, political news outlet. They should just do it. They should do it. I don't think Rocket will let them. Rocket's daddy now, so they're going to have to listen to Rocket either way. But owners of real say, hey, 32% of them say no impact. Okay, renters, 40% say no impact. Interesting that for renters, they're like, dude, no impact. For more renters and owners saying no impact for me. Delaying a major purchase for renters, 32%, 31% of renters, so similar there. And here's 39% are much less likely to make this major purchase this year. When they break it down into party, it's 19% Republicans, it's 60% of Democrats. So interestingly, I'd love to know, like, was this an even draw between the two parties? I don't buy too much into Redfin when they weave in a lot of this politicals, okay? A lot of this political stuff, because Redfin does like to they like to take a partisan stance, and then they like to find data, find surveys to support their political stance. Like 20 years ago, they took the stance, buyers want a discounted experience. And for 20 years, they jammed that down people's throats in articles and PR and commercials and what have you, and they got proven wrong. Okay, they took a bath. Investors took a bath with the deal with Rocket. So they'll take a position and then try to find data to back it up. What I do find interesting out of this, and one thing we need to keep in mind as professionals is like, listen, this uncertainty, the level of uncertainty doesn't work for a lot of people. And some people are going to take a pause on making a major purchase. And some are going to be ill-advised to do it. They're just going to think it's the right, like I should wait until, prices come down, right? And it's always one of those things. I should wait till prices come down. There's a lot of uncertainty and prices are higher. Again, if I go back into the hot sheet classroom, favorite chart, and I go to, the home price growth by decade, like, listen, no, there's uncertainty you can find in all four of these decades. I mean, this decade in particular, the 2000s, when home prices went up, they appreciated 47.3%. That was the great mortgage crisis, Lehman collapse. Okay. Wow. There's uncertainty in every single one of these decades that you can point to. What wasn't uncertain over the last 4 decades is U.S. home prices go up each and every single one of them. So while you're going to pause and it feels natural in times of uncertainty, let me just walk you through how much money that's cost other people when they've followed the herd. Okay. And so this is a herd mentality right now that's happening. If you can afford to make a purchase, like Josh Rubin style said on Knowledge Brokers podcast, like people that can afford to do it, if they're getting the right education, they're moving forward with those purchases. So for those that can afford to do it, and I get it, affordability is super crunched, and all of that, I wouldn't follow the 1,004 U.S. adults that were surveyed by Redfin, and maybe 70% of those were on one side of the political aisle, which can skew it and support Redfin's position that they want to take. I wouldn't let that type of data influence big decisions for my clients, but I would also at the same time empathize, respect where people are coming from. They're hearing and seeing a lot of fear out there, which the natural inclination when you see all that fear is going to be to take a huge pause. Now, a pause, personalize the experience. You're a pro. Personalize the experience for people. A pause in a search, it might be validated by the data of what they're dealing with. But if they can afford it and the data is, I want to wait for prices to come down, that's going to be a flawed plan from day one. Brad, did Redfin hurt me? No, but their headlines can hurt a lot of people. And so this is why we're talking about their headlines. Okay. They didn't hurt me. I'm not hurt by it. I know how to see through the partisan hackery that a Redfin often will. And listen, I love their website. They got a lot of great data. When you just look at the numbers, they've got a really good product there to source some data across the country. But when they write headlines, I need to address them. And you're going to need to address them with your clients, because a lot of those headlines are going to get picked up by CNBC, CNN Business, Fox Business. And that's going to be the stuff that your clients see. So if you want your clients to be hurt, I'm not triggered by Redfin emotionally. But some people are going to get triggered by some of this data emotionally. Not going to be me. That's why I talk about it. All right, let's take a look at cash markets right now here across the country. Zillow data is in here from the last week, and they've got Vegas, Wichita, Des Moines, Iowa, Charlotte, Tampa, top 5, Orlando, Atlanta, Denver, Phoenix, and LA. That's your top 10 for cash markets, top 10 housing markets for cash offers. Interesting to see Florida on that twice, Tampa, Orlando. So some of these markets where the inventory is increasing, you're seeing cash come in. It was interesting. I was just having a training with my team about cash, and somebody made like a really low offer up in Connecticut where inventory is super tight. You can't do that in a place like this, but really under asking price. But it's like, hey, I'm cash. Well, okay, like if you're talking about a 10, 20% gap in your like that's not going to be something that the seller considers. Think about this. 4 out of 10 home sellers own their property cash. Homeowners, 4 out of 10, they own the house. They have no mortgage. Okay. So just because you're a cash buyer and you're trying to negotiate with cash and wanting a discount, not going to work. We haven't seen it work in quite some time. 1 out of 4 buyers right now are cash. Okay. So understanding who you're competing with if you're a mortgage buyer, all of these data points are important. And here are the markets that people are moving into it with cash offers at the greatest scale. Las Vegas being on the top. Las Vegas still a market that is moving. A lot of things changing in that market, but understanding like what real advantage does cash have versus mortgage or vice versa. That's something I think that's really important to explain to clients who think cash is just like cash is king. Nice little catchphrase, but depending on the market, is it really? All right. Dow tumbled 600 points here, by the way, as Trump and Powell are having their little back and forth. Powell hawkish last week, didn't like it, but you know who did like it? The 10-year kind of liked it. So I like it. I'm fine with it. 10-year here stabilizing to 4.362. An elevated level, obviously, of where we've been over the last 30 days. Love to see it move down, but I don't know, 4.362 is in line with staying here under 7% on the 30-year fix, as we saw last week. We ended on Thursday at 6.87, and we'll see where we end up here Monday after the holiday. 6.87. That's the number to beat on the 30-year fixed as we go through today. CME forecast, listening to Jerome Powell last week saying, yep, 90% chance, damn near no change on the Fed cut here coming in 16 days, or the Fed meeting coming in 16 days. All right. Coming not in 16 days, but in just 2 days is BAM Fest. It's Wednesday, this Wednesday. The day is here, noon Eastern on Wednesday, 9 a.m. Pacific time. And you do not want to miss this. I'm telling you, if there's one of our virtual events that you do have to miss this year, we do 4 a year. This isn't the one, and it's because of this right here. That mystery guest. Of course, all the guests, everybody that we have, it's going to be exceptional. But you don't want to be the one that misses this. We've got Jimmy Burgess also doing YouTube Blueprint. Veronica Figueroa and I are going to do a fireside chat. The surprise guest with doing a fireside with Sharon, and myself and Eric, the broker agent, are going to be your hosts. We've got entertainment. We've got a DJ. If you did BAM Fest last year, you know this is an epic virtual experience and totally free. So sign up so that you don't miss it now. Bamfest.com. Now Bamfest.com. This Wednesday noon. Can't wait to see you guys there. BAMX, if you want to jump into that, it's school.com/BAMX. We'll have a link below so you can do that. But I'm really looking forward to Wednesday. Epic experience. Glad to be back, and looking forward to the week here on the Hot Sheet. Best way to support the Hot Sheet and all the content that we put out at BAM is just subscribe down here on the channel. It's a free, simple way to support. Make sure you do that. I'll see you guys back here tomorrow morning. Until then, of course, toodaloo.